Okay. Like during our first meeting, that's that is a time that we are looking at environment for financial management. We did an overview of the syllabus where we look at how the financial management examination question is going to be. We look at the structure of the exam, and we said that question 2 will always be about business valuation or mergers and acquisition. So question 2, which will be for 20 marks, will be that they can bring a question on business valuation, or they will bring a question on mergers and acquisition, or they will merge the two. They will bring a question that will have part of what? Mergers and acquisition, and that will have part of business valuation. So the question, they can bring a question that is going to have a part of business valuation and also a part of what? The mergers and acquisition. That will be for 20 marks, whether you like it or not. You can go to hell and come back. You see a question on business. You see a question on business valuation, which will be question 2 for 20 marks. So how would the question be? Part of it will be calculation, and part of it will be what? Will be theory. So you can have a theory that will go for 6 marks, and you have a calculation that will go for 14 marks. Or you can have a calculation that will be for 12 marks, and you also have a theory that will go for 8 marks. So it's sometimes they can give you a calculation for a full 20 marks, but sometimes they can give you a calculation for 15 marks, maybe theory for 5 marks. So they are going to do a combination over there. All right. So the question 2 is all about business valuations or mergers and acquisitions. So this evening, we are going to start with the business valuations. Every Friday, we finish it. Then Sunday, we look at mergers and acquisitions. It's not anything, so we can use a day to finish it. Okay. So we are going to start the business valuation this evening. If we are not able to finish, and I'm not even hoping to finish, although I normally use three hours to finish it, but we can't do that. Let's use 2 meetings to finish it. So check. It might be your this thing, because I'm talking. Okay. So we are going to look at business valuations. Okay. Business valuations. Okay. If they say business valuation, hey, you can't hear. Please, can someone hear me?
Yes, I can hear you.
Yeah. So you can hear me from the beginning, isn't it?
Yes, please.
And so it might be people your problem. Those who are saying that they can't hear, it might be your network. All right. So if they say business valuation, what will come to your mind? Business valuation, or valuing a business, or valuation of a business. Business valuation. What does it mean? Business valuation. What does it mean? Auntie Ajele, business valuation. What are you going to say? Business valuation. What does it mean? Business valuation.
Linus, please, today I can't talk 1 minute and I'm listening, so I can't answer. Please ask someone else, I beg.
But you are talking.
But the place is noisy.
But you are saying you can't talk.
But you are saying you can't talk.
I can hear you talking. That is my problem. Okay. Yeah, Auntie Agnes, business valuation. What comes to your mind? They say business valuation, or in the exam they ask you, what is business valuation? What are you going to write? Auntie Agnes, or you're also in a car?
Please, I'm not in a car today.
Okay.
So, business valuation I think it's the worth of the business
Okay.
at
Okay.
a particular point in time. Yes, the total value. When you value the business, the totality of the business at a particular point in time.
Okay. Okay. What you are saying a value of a business. Okay, that is a value of a business. How much the business worth? That is a value of a business. Okay. 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 All right. Auntie Lizzie, your hand was up. Business valuation.
Yes, you have said it. But what I can add is that the value of a business at a particular point in time. That's what
Okay.
I can add. So you are very
Okay. Okay. But what people you are defining is a value of a business. Value of a business. So people you are talking about value of a business. Okay. People you are talking about value of a business. Okay. But a business valuation means that you are valuing the business, putting a value on a business. That is what we call a business valuation. So if you try to put a value on a business, what do you mean by the business? We are talking about putting the value on the equity shares of the company because the equity shareholders are the owners of the company. So if you are trying to put value on the equity shares of a company, we are saying that you are trying to value the business. So business valuation is trying to put a value on the business. Trying to put the value on a business is what we call the business valuation. All right. The question now is, when should we value a business? Or why is it important for us to value a business? Okay, you see, sometimes the business valuation is the company that you are going to be valuing will always be an unquoted company, a company that is not listed on the stock exchange market. So we try to find value for their equity shares, or we try to find value for the company. But a company that is listed, you can easily get the value because you can go to the stock exchange, look at the market value of the company's shares, multiply by the number of shares that the company is having. So that will be very simple for you. So mostly we try to place a value on a company that is not listed. That is not listed. So the question now is, why should you value a business? Under what circumstances should we value a business? Because the business is doing well, we don't have any problem with the business. Okay, the business is doing well, everything is okay. So why should we put a value on a business again? Why should we put a value on a business again? Okay, so we are talking about why should we value a business? Why should we value a business? Or when should we value a business? Okay, we can be 10 equity holders. Okay, the company that we have, we are the owners are 10. So the equity holders are 10. Okay, or the shareholders are 10, or the equity holders or the equity shareholders are 10. Okay, one of these people want to sell his or her shares. Okay, if the company is listed, what will happen is that the person will just say, okay, what is the current market price of the shares of the company? So the person will look at it and the person will sell. The person will just multiply the price by the number of shares and sell it. But the question is, if the company is not listed, how do we value the share? What value are we going to place on the share? Because since the company is not listed, the company is not having a current market value. Since the company is not listed, the company is not having a current market value because the company shares are not on the stock exchange, market. So how do we get a value to place it on the shares of the company? So let's assume that we are into a private company that is not listed and the person wants to sell the shares. How do we get a value now? How do we get a value now? So we have to find some methods or some things to do to get a value of the share of the person. So sometimes if some of the equity shareholders or some of the shareholders want to sell their shareholding, it is necessary that we have to value the business to find a portion of their shares. So we can value the total business. If the person's shareholding is 20%, then we can value the total business. And at the end of the day, we find the 20% of the total value of the company. And that will represent the person's shareholding, and the person will sell. So we value a business when some of the shareholders are or some of the shareholders want to sell or want to dispose of their shareholding. So that is one of the reasons that we value a business. Okay. The next one is we can value a business if the business want to go public for the first time. So the company wants to trade in the public for the first time, or the company wants to go public for the first time. What do you mean by the company want to go public for the first time? That means the company want to get listed. So the company want to get listed. It means that the shares must be what? Must be priced on the stock exchange market. So you have to value the business to get the value of the shares that will be put on the stock exchange market. Okay. A parent company might also want to dispose a subsidiary that they acquired. So a company acquired a different company and they want to sell the company now, which we call the head for sale. They want to sell the company, or they want to sell the subsidiary now. What are they going to do? They have to value the subsidiary and know how much they are going to what they are going to sell it. So if a parent company wants to dispose a subsidiary, we have to value the subsidiary for the person to, or for the parent to dispose of the subsidiary. Sometimes in times of liquidation, if the company want to liquidate, the company wants to go out of business, maybe they want to close down for some number of time, it means that they are going to be selling their asset to settle their liabilities. What they do is that they have to value their assets now and know the value or the amount that they are going to realize from the assets. Then they will sell it and use the proceeds to settle the creditors and also the debt holders. So in times of liquidation, we can also value a business, or we can also value a company. We can also value a company if we want to go in for loan. Okay, so if you want to go in for loan, there are certain companies that they cannot give you a certain amount of loan because of the size. So if the value of the company is very high, then they can give you the loan. Or if you determine the value of the business, now what is the debt component of the company? So if you value the business and you are seeing that the company is having more debt than equity, it means that no lender will be willing to give you money, because you already have a lot of debts. How will you settle the new ones that you are going to take? So we can also value a business to use it as a collateral security to take loan. So if you value the business and the business is having more of equity, it means that the company is using less of debt. So we can give you that loan so that you will be able to pay, because you are not using much of your cash to pay interest because you are having more of equity. So they can also give you the loan in regards to that. So these are some of the reasons or some of the circumstances that a company might value or we value a business. Okay, let me just show you those ones. We have so many methods. This is one of the easiest side of the FM. Okay, so business valuation is the process of putting a value on a business on shares in an unquoted company. And I said that the only company that we normally value is the company that is not listed, which we call the unquoted company. Company that is not listed. But a company that is listed, their share price are on the stock exchange already. So if you want to know the value of a share, you can just go to the stock exchange and you get a price there. That is all. You don't have to suffer. But we do the business valuation for a company that is not listed. And how do we do it? We have a lot of methods that we use. All right. There are several methods of valuation and to compare the values they produce in order to make a decision. Okay, I don't know what they are trying to say there. Nature and purpose of the valuation of a business and financial assets. There are a number of different ways of putting a value on a business or shares for an unquoted company. A share valuation will be necessary when, so these are the important, or these are the purpose of valuing a business. For unquoted companies, in a takeover bid, offer price might be estimated at fair value, which is in the excess of current price or this one. So if they want to take over, in a case of takeover, we want to know the value of the company that we are taking over. So we have to value the company before we do the takeover. So the company can be saying that they have an asset. They have a plant in their books. They have a plant which is 20,000. That is the plant in their books, which is the carrying value of the plant. But in actual sense, in the market now, these plants will be sold for what? 15,000. So if we don't value this business, it means that you are paying more for what? The plant than what you should. Because currently the value of the plant is 15,000. What do? We have to value the plant. We have to value the plant before we take over. So you have to bring the value of the plant to 15,000. So in the takeover bid, in the form of takeover, you have to value the business that you are going to take over. You have to value the business that you are going to take over, or you have to value the target company, the company that they are going to acquire. We call it the target company. And the company that is going to buy or that is going to take over, we call it a predator company. Okay. So unquoted companies wishes to go public. Go public, I've said that already. They want to get listed on the stock exchange market for the first time. So going public means that you want to get listed, because you and I agreed some time ago that a company that is not listed is not what? Is not required to what? Publish their financial statement to what? To the public. They are not allowed to what? Issue their securities to the public. So they do what we call placing. But if the company want to issue, which is the initial public offer, they want to issue shares to the public, it means that they have to get listed on the stock exchange market. So the company want to get listed on the stock exchange market, they have to value their shares. So holding company wishes to sell subsidiary and is negotiating the price. I have said that one already, where a parent wants to sell what? A subsidiary. A company is in a liquidation situation. I've said that one also already. There's a scheme of merger with another company. So if there's a scheme of merger with another company, what do we call a merger? Two companies. It can be merger, it can be related or unrelated. Where the related one is what? Tigo and what? Airtel. You can see that Tigo and Airtel are competitors. They are in the same business. So if you are merging companies that are in the same business, we call it that merger is related merger. So if Airtel and Tigo are coming together, they want to form one business. They want to come together to now form what? A single business. But the issue now is, what will be the value that Airtel Tigo is bringing to the new company? What will be the value that what will be the value that Airtel is bringing to the new company? What is the value that the Tigo is bringing to the new company? We have to value their company or their asset at the date of the merger to know, okay, this is the portion of the value that Airtel is bringing, and this is the portion of what? The value that what? Tigo is bringing. So in times of merger, we can also do that. Merger is two companies merging together. This is not acquisition. So you are just coming together to form a single force. That is merger. We also call something amalgamation. Okay, so for the merger, after the merger, there will be a different name. But for amalgamation, you can decide to take one of the names. So the Airtel Tigo is a different name on its own. So that is a merger. But if it should be amalgamation, they can try to use maybe Airtel, if Airtel is the majority owner of the new firm now. So amalgamation, we just maintain one of the company's name. But for merger, we come with a different name altogether. Okay. Shares are sold. When one of the shareholders want to sell the shares, we can also do that. Shares are also pledged as collateral for loan, and the bank want to put this one. I've said all those things already. So let me just look at the methods. We want to value the shares. If you want to value the shares, what we are doing is that, or if you are valuing a company, you are only valuing the equity value, because the business is being financed, or the asset of the company is being financed through what? Equity and debt. So if you are valuing the company, it means that you are going to be using the value of your asset to settle your debt. So the remaining portion will be for what? The equity shareholders. So we only value the equity portion. So it means that we are looking for only the net asset, which is the total asset minus the total liabilities. That is what we are going to look at. So we want to find equity. So the business value, the valuation that we are doing is that we are just finding the equity portion. The equity portion can be on total basis, or it can be on unit basis. So you can ask you to find the value per share or the value of the company. Okay. We are looking for equity. Let's take this for the accounting equation side. Okay, the accounting equation is giving us what? Okay. The accounting equation is giving us what? Accounting equation.
Asset equals capital plus liability.
Okay, total asset is equal to the equity, which is the capital plus what? Liability. All right. Now we are looking for equity. We are only looking for the value of the equity shares. So if you are looking for equity, what are you going to do? How do we find equity here? It means that we have to make the E the subject, isn't it? Is that the case?
Yes.
Okay. So can we say that we have A minus L is equal to E? So equity is equal to what? Asset minus what? Liability. So we can also find the equity, or the value of a company using the what? The accounting equation. And one of the, let me talk about the methods. The methods of valuing a business, or business valuation methods. Okay, or business valuation techniques. It can be any of them. So methods of valuing a business. Okay, so the first method is what we call the balance sheet valuation method or the net asset method. So you have the net asset method, the net assets, or the balance sheet valuation method. Okay, what you have to know is that we are only finding the value of the equity. So this one, using the net asset or the balance sheet valuation method, we use the accounting equation.
Hello, Linus.
Yes, senior.
Okay, so let me ask some quick question. Okay, in the case of maybe when you are asked to state the method of business valuation,
Okay.
and you write only asset-based method, would that one also be considered, or you need to write net assets or balance sheets?
Okay, if you write the asset base, maybe you can, if you are going to, if they say state and explain, the stating is not a problem. Okay, so you can write the asset based method, but that one, you are going to explain to them what you meant by what the asset based method. But if they're just asking you to state, that means that you have to be more clearer in your stating. So it will be the net asset based method, because that one you're not going to explain what we mean. So you just write the correct one. Okay, because we say the asset base, it can be a total assets. Okay, but if you are saying the net asset, it is more defined than the asset based. So the asset based, it can be total assets, it can be anything. So we just make it the net asset based method or the balance sheet valuation method. But if you are going to explain it, then you can make it the asset based and now explain what you mean by the asset based method. All right.
Okay.
Okay. Okay. So for the net asset or the business, but the balance sheet valuation method is the simplest among all of them. It's just the straightforward. It's just how you find the accounting equation. So the net asset over here, for the purpose of business valuation, the net asset is defined as total asset minus total liabilities. The net asset over here is only the shareholders fund. So the shareholders fund is calculated as the total asset minus the total liabilities. So your value of a business, your value of the business, or value, hey, why am I writing valuation? Okay, so your value of the business is calculated as total assets, total assets, total assets minus the total liabilities. But the question now is, what values are you going to be using for your asset and your liabilities? Okay. Sometimes they will say the people want to continue Like you are going to buy the business and continue using it. Or the people, they just want to value the what? The business and continue. So if that is the case, mostly we use what? Replacement what? Cost. So sometimes if you are going to, if the business will be on going concern basis where they are going to continue using the business or they are going to continue with the business, we use a replacement cost. But situation where you are going to get the company listed, if it is be for listing, we use the what? The market values. If you are going to sell it, we are going to use the market values. And mostly in the exam, it will be either listing or for sale. So if you are going to sell, then you use the current market values or the fair values. But if you are going to continue using a business, then we use the replacement cost. But if you are going to sell it or you are going to get listed, we use the what? The fair values or the market values or what we call the breakup values. So if you see the breakup values, they are the same as what? The market value. But the breakup value is where you want to sell the what? The business or you want to sell the assets. So what I want to tell you is that in most of the exams, you are going to be using the fair value or the market value. So they are going to give you a statement of financial position. So in the statement of financial position, they can give you a land and the land will be 20,000, which is the carrying value of the land. They can give you equipment. The equipment to be 25,000. Okay, but they can give you additional information, which will be the footnotes. Then they will say that the market value of the land, is now 25,000. So if you want to value the land, you will now use the new what? The new value, which is 25,000. So we use the new value. This is because this is at the time that we don't want to sell. But if you want to sell now, they are now saying that the value of the land or the amount that you can sell the land is now 25,000. So you pick the what? The fair value. They can also say that the equipment is now 23,000. It means that the value has reduced by 2,000. But reducing by the 2,000 is a revaluation loss, which is not our problem. We are only valuing the asset using the what? The net asset method. So we always use the what? The market values, unless the question is saying that the people are going to continue with the business. If that is the case, then we use a replacement cost. We use the replacement cost. Or sometimes the question can also ask you to use the book values. Using the book value means that you have to use the historical values, the value in the statement of financial position of the company. Okay. So this is just by this one. We are going to pick one question on this one before we move on to the other methods. Okay. Okay. So the value of the business, this is the total value. So we have the total asset minus the total liability to give you the total value of the business. Sometimes the question can ask you to find value of a share or value per share. So value of a share. Okay. So you will see that if you subtract your total liability from your total asset, you are going to be getting the net asset, which is the equity values. So they are asking you, this is the total value for the number of shares. They are asking you for value of a share. So you divide your answer by number of shares, number of ordinary shares. We are looking for only the equity shares. So if you have preference shares, the preference shares will be treated as what? As a liability. You subtract the preference shares from your total asset. We are only looking for the shareholders fund. So the meaning is that if your total assets is 20,000 and your total liabilities is 5,000, okay, it means that your value of or the shareholders fund will be 15,000. The question can tell you that they have a number of shares in issue of 5,000. So number of shares is 5,000. So the question can ask you to find the total value. They ask you to find the total value. This is the total value. They ask you to find the value of a share. It means that you will divide the 15,000 is for the 5,000 shares. So what will be one share? So you divide your value by the number of shares. It means that the price of a share will be 3 cedi. So sometimes they can ask you to find a value of a share, or they'll ask you to find the value of the business. They ask you to find the value of the business. It is the total value of the business. But they ask you to find the value of a share. it is a value per share. So you divide your total value by the number of shares that we have. So let's pick one question before we move on to, or let's pick at least two before we move on to the, okay, I will talk about what we call market capitalization, what we call value of a business and market capitalization. So don't worry, we will look at that. They can also ask you about the, okay, before we look at example, let me say this, I've forgotten. Okay, in your valuation, in your total assets, we don't include intangible assets unless they have what? A market value. So if you have a goodwill, we don't include a goodwill. If you are valuing the business, we don't include a goodwill. We only include the what? The tangible asset, the asset that you can actually pay for. So if you are valuing the business, we exclude goodwill. If there is patent, we exclude a patent unless there is a market value for the patent. So we don't include what? Intangible assets in the valuation. We only use a tangible asset. We only use a tangible asset because what we are trying to say is that goodwill is not having a value. Goodwill is not having a value. So the person will only pay for the what? The physical assets. So we exclude what? The intangible asset unless they have what? A market value. So if they have a patent and they are now saying that the patent is now worth 15,000, then use the 15,000 for the patent. But if they don't say anything about the patent, then you assume that the patent is worthless. It will not be realized, so it will be zero. So we don't use the intangible assets. They can ask you about advantages of using the net asset method or the balance sheet valuation method. One thing that you have to know is that it's very simple, and the information that you can use is readily available. So the ready availability of the information is also one of the advantages. And the simple and it's very simple to calculate and understand because we all know that total asset minus total liability. There is no formula. There is no complex thing that you have to do. So it is very simple to calculate and understand. And it also provide what? A readily available information that is going to be used for the what? For the calculation. You have your assets here, you have your balance sheet there. You can go and pick the figures there and also use it. All right, and it's one of the most common method used in what? In business valuation. But if you come to the disadvantages, it does not consider the impact of what? Intangible assets in the business valuation. So we ignore what? Intangible assets. For example, goodwill. Another one also is that we use what? Most of the time we can use historical costs where we are using the book values. And the book value is not going to give us what? An accurate what? Measure of what? The company. Because we are using the current value. But in actual sense, the value might not be the same as this one. The market value might be different from this one. So it can also give us some misleading what? Figures. It can also give us some misleading figures. So they can ask you about advantages and disadvantages. If you have phone, you can Google it, or you can write the ones that I have said. All right. So let's pick a question. Then we count to the other ones. If care is not taken, we can finish today. But I want care to be taken, so we are not going to finish. Okay. So let me see question one and see. I don't want to write the plenty formulas for you before we start. So let's do it one by one. Okay, so let's do the question one. Okay, so let me see whether I have a question that is relating to only the. Okay, so let's look at the question two. Someone should read the question two for us. Auntie Akuya, can you read for us? Okay, Sinaremo. Okay.
Okay. That's tutorial question 2.
Yes, please.
Okay. The owners of a private company wish to dispose of their entire investment in the company. The company has an insured share capital of 1 million Ghana cedis of 50 Ghana pesos nominal value ordinary shares. The owners have made the following valuations of the company's assets and liabilities. Non-current assets, book value, 30 million Ghana cedis. Current assets, 18 million Ghana cedis. Non-current liabilities, 12 million Ghana cedis. Current liabilities, 10 million Ghana cedis. The net realizable value of the non-current assets exceed the book value by 4 million Ghana cedis. The current assets include 2 million Ghana cedis of accounts receivable, which are thought to be irrecoverable. Required. What is the minimum price per share which the owners should accept for the company to the nearest Ghana cedis?
Okay, thank you. So you can see that this particular question, the method that we can use is the net asset method, isn't it? All right. So the net asset method is the total asset minus what? Total liabilities. Okay. So right now, mostly they will give you additional information. They will give you additional information. These are the book value. This is the values that we have in our books. Okay. But in actual sense, at the date of the valuation or the date that we have made a decision to sell the investment, the value that we have in the books might not be the same as the value in the market. So you cannot be telling me that the value of the asset that I have is 30 million. And they are now telling me that the net realizable value of the non-current asset exceeds the book value by 4 million. So it means that the non-current asset will now be what? What will now be the new value?
That will be 26 million.
No, please. Look at it again. The net realizable value of the non-current asset exceeds the book value by 4 million.
So 34 million.
Okay, that will be 34 million. All right. So I want to sell my investments in the company. And you are telling me that okay, the value of the asset that we have in our books is 30. But in the market, if you want to sell, it's 34 million. Which figure are you going to pick? Which figure
So
are you?
I'll pick the market value.
So you pick the 34. So mostly we value the asset at their market value. The same way the value cannot be 34 million in your books, and they are now saying that it's 30 million, and the buyer will say that he's going to pay for the 34 million. No. You pay for the 30 million. So mostly we use the what? The market value for the valuation. So they will give you the book values, all right, but the question will also give you the market value. But if there's no market value given for a particular asset, the assumption is that the market value is the same as the what? The carrying value in the statement of financial position. So let's look at this one. First of all, we have to calculate our net assets before we calculate the value per share. So let's look at let's calculate our net assets. Okay, so the net assets, let's put the currency here. They are all in million. The first one is non-current what? Non-current assets. And you can see that the non-current asset, the book value is 30. They are saying that this has increased by 4. So we add a 4. So now have 34 million. Okay, let's go to the next one. Okay, let's go to the next one. The current asset, the book value is 18 million, but they are saying that the current asset include 2 million of account receivables, which are thought to be what? Irrecoverable. So what will now be the new value of the current assets?
16 million.
That will be 16 million. It is 18 million. By the time that you want to sell, you realize that 2 million of the people who are owing you are not going to pay. It means that you are going to transfer only 16 million to the person, and this will be a bad debt. So we go there, we have we have the current assets to be 18 minus 2. And that will give us 16. Okay, let's come. So they haven't said anything about the liabilities, isn't it? Okay. Since they haven't said anything about the liability, it means that the liability over here, the book value are the same as their current value. So you just pick them like that. Okay. So we have the non-current liability.
Hello, Linus.
Yes, yeah.
So in the course of solving this,
Yeah.
if you bulk all the figures together, will
Okay.
it affect your marks?
If you just put the 34 million there,
Yes.
okay. They will mark the 34, but the only thing is maybe they might be expecting you to show how you got a 34 because they have given you 30. You are now writing 34. So how did you get a 34? That's why we are doing the 30 plus 4.
Okay.
Yeah. So maybe the 30 plus 4, they will give you 6 for that one before the 34 will also take 6 again. Okay. All right. So let's look at one side of doing this. So now current liabilities is how much? I didn't look at that one. So the non-current liability is 12 and current is 10. So we are going to be having 12. That will be subtraction. And current liabilities will be 10. What will be the total?
28.
28.
Oh.
So that will be the total. So they are now asking us for value per share. So the value per share will be the net assets divided by the number of shares. So the question now is, how do we find our number of shares? Let's go to the question and see whether there are some things over there that can help us to find the number of shares. Okay, let's read from the top. They say the company has an issue share capital of 1 million of 0.50 nominal value ordinary shares. So what is their total value of their equity shares? What is the total value? The total value is 1 million. Okay. And each share, so the total value over here, how do we get the total value? Is the number of shares, total value.
Divided by the nominal value.
No, this is not the number of shares. So this is the value. This is in the currency. Okay. So it will be the number of shares multiplied by the share price. Multiplied by the share price. Multiplied by the share price. And that was how come we got the 1 million. So 1 million was gotten as not the number of shares which we don't know multiplied by the 0.5. So if you multiply the number of shares by the share price, which is 0.5, you'll be getting 1 million Ghana cedi. So the question now is how many shares that we have that we multiply it by 0.5 and we have gotten 1 million. So you just have your number of shares will be calculated as the value of the share, which is the total value, which is 1 million, divided by the value per share. And that will give us 2 million shares. So the shares that we have will be 2 million shares. So the 2 million shares, if you multiply by 50%, you'll be getting 1 million as the value of the shares. So if you want to find the number of shares, it is the total value of the shares divided by the share price or the value per share, which will give us 2 million. So what we do over here is that we divide the 28 million. So we have the 28 million here. So we have the 28 million divided by 2 million. How much are we getting?
14.
That will give us 14 cedis. Not 14 million. It will be 14 cedis. Okay, that will be 14. Okay.
14 cedis.
No, it will be 14 million. Okay. So 14 million times 2 million will give us 2 28 million. It will be 14 million. Okay. All right. This is how you find the value per share. Okay. Another way of it will be 14 cedi, not 14 million.
Yeah.
Be 14.
That seems to be
14
fair
cedi.
share.
Yeah. Okay. Or if you want to do it, do the 28 million. Write all the zeros. You see that the 2 million, the 60 will cancel the 60. Then it will now be left with 28 divided by 2. So that will be 14 cedis, not that one. All right. Okay. So this is how you go about it. But I can also find the net asset using different method. How do we do that one? You can first what? Find the value of the equity. You can find the value of the equity using this without considering the impact of the current market value. So you can find your equity from this one. Okay, you can find the equity from this one. So if you find the equity from this one, what will be our value? So this will be 30 plus 18 minus 12. 48 minus 12 will give us 36, and this will give us 26. Okay, so our equity is 26. This is because this is before taking into consideration what the impact of the current value. Okay, so this one, the value was 30 million. Okay, they are now saying that the net valuable value of the non-current asset exceeds the book value by what? 4 million. Okay, so if you are doing the net asset table, if the value of an asset is increasing, it means that it will automatically increase the net assets. So it means that we have used 30 over here. Now it is 34. It means this value is going to increase by 4. Okay. This we have used 18, but it should have been 16. It means that the 2 now is going to reduce this by 2. So you can find the equity first, then you now adjust the what? The current market values, the movement in the current market value against it, like the way you do it under net asset method. If you are doing maybe console or something, those who have done financial reporting. So you can first find the equity before you adjust it. You find the equity based on the book value, then you adjust it with the what? With the increment or the decrease. This will still give you 28. Okay. So you can also do it like that, or you just use the what? The market value straightforward and move on. All right. So this is about this one. Let's look at other methods. The other methods is just a formula that we normally play with. So we can use what we call the income-based method. So mostly they want to ask you a question. They want to ask you to value a business. The valuation will be the first method will be the net asset method. Is the one of the commonest one that they have been asking. The next one will be maybe some of the income-based method. Okay, so the income-based method, we have 2 methods that we normally use. We use the price-earning ratio, and also the dividend yield ratio. Okay, one thing that you have to know is that we are saying that we are finding the value of the equity shares. It can be a value per share, or it can be a total value. So what you do is that we just pick some of the ratios that is having a market value in it. Then we manipulate the ratio to have the what? To have the market value. Okay. How do we calculate? How is price earning ratio calculated? Price earning ratio. How is it calculated? Price earning ratio is calculated as what? Hey, Sines, how do we calculate price earning ratio? How do we calculate price earning ratio? Senior Prince, how do we calculate price earning ratio? Auntie Agnes, how do we calculate price earning ratio?
Please, I'm not so sure. Maybe price per share over
Is that
earning per share.
what per share?
I'm not so sure, but maybe price per share.
Okay. So it is the price. So the price earning ratio is the price market value per share. So the market value per share divided by the earnings per share, which is on unit basis. Or you can also calculate it by what we call the total market capitalization value over the total earnings of the company. Okay. So our price earning ratio is calculated as the market value per share divided by the earnings per share. Okay. The market value over here is for the equity shares. So what we are doing is that we are looking for the value of the equity shares. So it means that we can use the price earning ratio to find the market value given over here. So how do we find the market value? We can manipulate this particular formula. So it is market value divided by earnings per share. So we can manipulate this particular value to get our market value per share. So what we do is that, okay, what we do is that we make the market value the subject. So making the market value the subject, we can say that our market value per share is equal to the price earning ratio multiplied by the earnings per share. So you can also find the market value using the price earning ratio as what? Price earning ratio multiplied by the what? The earnings per share. Okay. How do we calculate a price earning ratio? Price earning ratio is calculated as a market value of the earnings per share. But the question is, we can calculate earnings per share of the company that we are valuing, which is the unlisted company, which is the unquoted company. But the unquoted company is not going to be having a market price. So it means that that particular company cannot be having a price earning ratio. So we are valuing unquoted company, and price earning ratio is calculated as a market value over the earnings per share. The company that is not listed, we can calculate earnings per share for them, but we cannot get the market value per share for them because they are not listed on the stock exchange market. So we don't know the value of their share as of now. So the question now is, if we cannot get the market value of that particular company, but we can get their earnings per share, it means that the company that we are valuing cannot have their own price earning ratio. So what we do is that the price earning ratio that we use is that we use the price earning ratio of a similar company that's listed. So we use the price earning ratio of a similar company. In the process of valuation, the price earning ratio that we use the price earning ratio of a similar company, which is what? Listed. Okay, the similar company should be in the same industry, which is listed. So we use the price earning of a similar company which is listed. So that can be like, we want to value what? We want to value Ghana Guinness, but Ghana Guinness is not listed. Okay, if Ghana Guinness is not listed, Casablanca is listed, we can use the price earning ratio of Casablanca to value the value of what? The Ghana Guinness. So we use the price earning ratio of a similar company that is listed. But if the company is listed, then it means that we use the price earning ratio of that particular company straightforward. Okay, so we use the price earning ratio of a similar company which is listed. You have to be very mindful of this particular one. Don't go and be looking for price earning ratio of the company that you are valuing, because the company that you are going to be valuing will not be listed. It means that they don't have market value, so they cannot be what? They cannot have what? A price earning ratio. So what we do is that we use the price earning ratio of a similar company which is listed, but a company that is not listed, we can calculate their what? Earnings per share for them, which will be the total earnings attributable to the equity shareholders divided by the number of shares that they have. So we use the price earning ratio of a company, of a similar company which is listed, and we use the earnings per share of the company itself. So let's come here. Assuming the question will always give you that the price earning ratio of the industry or the average price earning ratio of the industry is, maybe they will tell you of the industry is 8. Then they can give you the earnings per share of the company, or you can calculate the earnings per share of the company yourself. Okay, so assuming the earnings per share of the company is also 10. So it means that the market value of the company will be the 8 multiplied by 10, and that will be 80. Okay, since the company is not listed, we can't use the full price earning ratio because they are not listed. If the company is not listed, it means that their value must be lower than what the company that is listed, because your share price on the stock exchange market is going to be based on your performance and the number of years that you have been on the stock exchange market. So what we do is that we try to adjust the the market value that we have gotten by at least 80%. We adjust it by 80% or 70%. So what we do is that we reduce the market value to 80% or 70%. This is because a company that is not listed cannot be having the same market value as a company that is listed. So after finding the value, you adjust it. That is, if you have used the price earning ratio of a similar company to calculate the market value of this particular company. So if you are using the price earning ratio, is basically the price earning ratio multiplied by the earnings per share of the company that you are valuing. Very simple. Okay. Sometimes the question can ask you to find, this is market value per share. We are finding the market value per share. They can ask you to find the total value of the company. So the total value is the value that you have gotten. So the value of the company will be calculated as, so the value that you have calculated over here, the market value that you have gotten over here, which is adjusted, multiplied by the number of shares. So that is how you are going to do it. So the value that you are going to get will be the value per share. So if you multiply by the number of shares, you get your total value. Or the value of the company can also be calculated straightforward as the profit after tax, which is attributable to the equity shareholders, multiplied by the price earning ratio. Okay, you can see that we calculate the earnings per share by dividing this by the number of shares. But this one, we don't want to divide by the number of shares before multiply by the number of shares here. You can see that at the end of the day, we are multiplying this answer by the number of shares because we use the earnings per share. So it means that if you are using profit after tax, the multiplication of the number of shares over here is already included over here. So we don't do that. All right. But don't worry. If you pick a question, you understand what I'm saying. All right. The second method under the income base, is what we call the earnings yield. Okay, is what we call the earnings yield. The question is, how is earnings yield calculated? The earnings yield is the reciprocal of what? The price earning ratio. So the earnings yield is what? 1 divided by the price earning ratio, or it is calculated as the earnings per share over the market value per share. This is how earnings yield is calculated. So the question now is, what are we looking for? We are looking for the market value per share. So our earnings yield will be equal to earnings per share over the market value per share. We are looking for market value, so we multiply both sides by market value times the market value is equal to the earnings per share. So we are looking for the market value. We divide both sides by earnings yield. So if you are using the earnings yield method, it will be the market value is equal to the earnings per share divided by the earnings yield. The question will give you the earnings yield of a similar company that is listed, because you can see that the earnings yield, we are also using market value. Since the company is not listed, we can't use the market value. But this one is without growth, if the earnings is not growing. So without growth. So sometimes they will say that the earnings will be growing at a constant rate of this one. If that is the case, then the formula will be different. So this is without growth. Then what with growth? If the earnings is growing at a particular rate, how do we do it? It will be the market value is equal to earnings per share into bracket 1 plus G over earnings yield minus G. That's how we do. It's just like the dividend growth method for cost of capital. How do we calculate it? The dividend growth method is calculated as the dividend per share over 1 plus G divided by the market value, which is the PO plus G, which will give you the cost of equity. So if you are looking for the earnings yield with growth, it's calculated as earnings per share 1 plus G all over the market value plus G. So if you are making the market value the subject, this is what you are going to have. We are going to have the earnings yield minus G is equal to EPS 1 plus G then over this one. So what you do is you making this one a subject means that you divide all through by the earnings yield minus the G. So if with growth, then we what? We factor the growth. But without growth, it is earnings per share over the earnings yield. Let me see whether we have a question that if there is earnings yield and those ones. Okay, there's a dividend yield in the first question. There's a dividend yield in the first question. So let me just talk about the dividend valuation models. So we have looked at the income valuation. The one that they use to ask in addition to the net asset is the price earning ratio. And the other one is the dividend yield or the dividend valuation models. So let's look at the dividend valuation model. So the third one is the dividend valuation model. The dividend valuation model. So the dividend valuation model, the first one is we can use dividend yield. Okay, we can use dividend yield. Using the dividend yield is calculated as dividend per share over the market value. So if you are making the market value the subject, it will be the dividend per share over the dividend yield. This is also without growth. This is also without growth. Okay. Then what about with growth? We factor it. So the market value per share will now be equal to dividend per share 1 plus G over the dividend yield, which is also the same as the cost of capital. So the dividend yield minus what? The G. This is with growth. If it is growing, this is with growth. Okay. So the first one, we can use the dividend yield model, or we can also use the dividend valuation model in the cost of capital. So if you are looking at the cost of equity, we can also modify or play with the cost of equity to get our market value, which is the PO, the SDF share price. So we can also play with the cost of equity to get the PO, which is the SDF share price. We know that the cost of equity without growth, which is a constant dividend, is KE is equal to DO over PO. Okay, so if you are making the PO the subject, this will give you PO is equal to DO over KE, which is the same as the dividend yield over here. So it's the same as the dividend yield for the dividend yield method over here. So the dividend per share over the what? The dividend yield. So this is the PO, which is the market price. The KE over here is the dividend yield, which is the same as the cost of equity. So sometimes they can give you the cost of equity and they can also give you the dividend yield. So that's why we are looking at the cost of equity again. Okay. This is constant dividend, if the dividend is constant. Okay. Let's look at dividend growing at a constant rate. Growth at a constant rate. At a constant rate. growth at a constant rate. If there's a growth at a constant rate, our KE is calculated as a DO into brackets 1 plus G over PO, all plus G. So if you are making the PO the subject, we are going to be having PO is equal to DO 1 plus G over KE minus G, which is the same as the dividend yield with growth. But this one, the only thing that you can see over here is that we are replacing the cost of equity with the dividend yield. So we can also play with the what? With the cost of equity formula to find the PO. We are looking for the market value of the share. So whatever item that is computed using the market value, we can be able to manipulate that to get the market value. So we can also use the cost of equity formula to get that. So they can give you anything at all to ask you to find the market price per share. So they can give you the items for the cost of equity. They can give you the cost of equity. They can give you the dividends, and they will give you the growth rate. And they will now ask you to find the PO, which is the SDIV share price or the current market price. Okay. The other method, all of these things that we are looking at over here, what we are doing over here, all the things that we have done so far is valuation of equity. So all of the things that we are doing is we are valuing the equity. So that is valuation of equity. We can also value a debt. So we can also value a debt. They can also sometimes give you dividends for every year. And they will give you the cost of capital, and they will give you the dividend for every year. Okay. The present value of all dividends, is the same as the market value of the equity. So they can give you a dividend for a number of years. If we discount all the dividends, if you add it together, that is the same as the value of the equity, because you are paying the dividends relating to what? To the equity. So I've given you 10,000 today, and you are telling me that you are going to pay to me in certain amount of money. So you are going to pay 5,000 every year. It means that the 10,000 I'm giving to you today is because of the 10,000 that you are paying me those amounts. So if I should present value all the amount that I have given to you, it means that it should be the same as the amount that I've given to you, which is the 10,000. And that is the assumption over here. So sometimes I can give you the dividends. If you present value all the dividends, that will give you your what? Your value of the equity. So all the net assets, the price earning ratio, the earnings yield ratio, the dividends valuation model, all those things that we have done right now is valuation of what? Equity. Is valuation of equity. The question is, how do we value debt too? We are going to look at that also. All right. But before that, we can look at the fourth method, which is the cash flow method. So the cash flow, sometimes they will give you, if the company should acquire the company, this is the cash flows that the company will be generating. So if you want to find a value, we can find a value based on what? The cash flow. So it means that if I'm giving you 10,000 today, it is the 10,000 that is going to generate those cash flows for me. So it means that if I should present value all the cash flows, it should be the same as the amount that I've paid for you. So we just discount all the cash flows. How do we discount it? We put the years here. We put the cash flows here. We put a discount factor, which is the cost of capital. Then we put the present value. We add all of them together and divide by the number of shares. Then we get your value per share. So we can also use the cash flow method. What you have to know is that we are using cash flow, cash profits, not just profits. So sometimes the question can give you a profit. They can give you net profit, and they can also give you a depreciation. Okay. They can give you profit, and they can give you what? Depreciation. The meaning is that if you subtract the depreciation from the cash flow, that is why you are going to have a profit, because a profit is based on cash and what? Non-cash items. So it means that if you depreciation is not cash, so if you add the depreciation to the profit, then you are now going to have a cash flow. So what will happen is that you add the depreciation to the profit to have a cash flow. It means that the depreciation was subtracted from the cash flow. That is where we have a profit. So if you add the depreciation back, then you have your cash flow. So they will give you profit. Try to add all the non-cash what items back. If you add all the non-cash items, then you are going to have your what? Your cash flow. So you can also use the cash flow method. You can also use the cash flow method. Okay, let's pick some questions before we talk about the valuation of debt. Valuation of debt is very simple. It is very simple. Valuation of debt is very simple. Valuation of debt is very simple. All right, let's look at question 1 because I've spoken about everything about the question 1. So we can pick the question 1. Then we pick the valuation of debts. Hey. Okay, you consider the last one. If the return required by the debt holder is 7.5%, calculate the market value of the irredeemable debt. Show your answer to the nearest city. So you can see that I have to talk about debts here before we can. So let me just talk about debt so that we can just pick a question. Then we know that we are just solving only questions. Let me talk about valuation of debts. All the things that we have spoken about is valuation of equity. So let's look at valuation of debt. Okay. We know that for debt, we have 2 types of debt, isn't it? Yeah, Auntie Agnes, we know that we have 2 types of debt. Is that true? Auntie Agnes, we have 2 types of debt. Is that true?
Yes.
Okay. These are?
I think long term.
Is it?
Long term debt and then short.
No, please. Transfer what you learn under cost of equity, cost of capital. You have learned something about debt under cost of capital. So if you can transfer of knowledge. Yeah.
Redeemable.
Okay. We have the irredeemable. We have the irredeemable and what? Redeemable. Okay. So what will happen is that we have irredeemable debt and redeemable debt. So the question now is, how do we find the market value of irredeemable debt? How do we value irredeemable debt? The first thing is that you have to ask yourself, how do we find the cost of equity of the cost of what? Debt for irredeemable debt. So how do we find the cost of irredeemable debt? So the cost of irredeemable debt without tax and with tax, how do we find it? So let's look at the cost of irredeemable debt. Cost of irredeemable debt without tax effects, or without taxation. Auntie Agnes, how do we find it? Cost of irredeemable debt without taxation. KD is equal to what? Auntie Agnes, KD is equal to what?
Without taxation.
Okay. Irredeemable debt without taxation. How do we calculate it? KD is equal to what? You have forgotten?
Interest over interest.
Okay, the interest over what? Okay, over the X interest price. Okay. Okay, all of them multiplied by 100. Okay. All right. So what we are looking for over here, what we are looking for over here. If you are valuing something, it means that you are looking for the price of the thing. So if you are valuing the irredeemable debt without tax, it means that we are looking for the XD and the X interest price, which is the what? The value of the what? The debt. So what we do is that we now make the X interest a subject. So it means that the price over here, there's the X interest price, which is the market price, will be calculated as the interest over the cost of the debt. So if it's without taxation, this is how we do it. So the price of the debt, the price will be equal to the interest over the KD. So with this one, we just play with the what? With their cost of what? Capital formula. So this is without what? Debt. This is without debt. This is without debt. Okay. This is without debt. But if it is, this is without taxation rather. So let's look at the price with taxation. With taxation, what will now be the position? So with taxation, our cost of debt is calculated as the interest into bracket 1 minus T, which is the after tax interest rate. After tax interest divided by the what? The price. Let me just use the price, or multiply by 100. So if you are looking for the price, it will now be calculated as the I into bracket 1 minus T all over the KD. And that's how we do it. That's how we do it. Okay. So this is for irredeemable. Let's come to redeemable debts. Okay. For the redeemable debts, you have to know that we use what? We use the internal rate of return. So the internal rate of return, the cost of debt that we are calculating is that we want an interest rate so that the interest rate will give, if all the cash flows that we are going to receive in the future, we need an interest rate that if we discount all the cash flows, the value will be the same as the what? The market value. That's what we are looking for. So we want an interest rate that if you use the interest rate to discount all the cash flows that are relating to the what? To the debt, it will be the same as the market value of what? Of the debt, which is what we call the break-even rate. The rate that is going to give you the market value be equal to the present value of all the cash flows. That's what we call the internal rate of return. Okay, so for irredeemable debts, what we do is that the cost of or the value of the irredeemable debt is calculated like this. We just discount all the cash flows at the cost of capital rates. So they'll give you the cost of the debt, which can be 8%. So you use the 8% to discount all the cash flows. What are the cash flows? It will be the interest for a number of years and also the redemption value. Also the redemption what? Value. So if you add them, that will give you the market value of the redeemable debt is equal to the present value of all the cash flows. All the cash flows will be the interest. All the cash flows will be the interest payments. And maybe the redemption amounts or value. Okay, all of them discounted at the cost of debts. The cost of debts rates. Okay, so that is it. So the market value is just there. You just present value. If you discount all the cash flows, which is the interest and which is also the redemption value, which can be at par or at premium. If we discount all of them and add them, that is the value of the redeemable debt. If it is convertible debt, it's the same as this one. If the conversion is not possible, if the conversion is not possible, it means that it will be treated as what? Redeemable what? Debt. But if the conversion is possible, it's the same thing. But what we do is that we replace the redemption value with what? With the conversion value. That is the only thing. That is the only difference. Now, how do we do the preference shares? How do we value a preference shares? This have to do with if the preference shares is redeemable or irredeemable. If it is redeemable, it will be, the market value will be accounted for in the same way as a redeemable debt. But if it is irredeemable preference shares, if it is irredeemable preference shares, if it is irredeemable preference, if it is irredeemable preference shares, then it will be the cost of preference shares, which is equal to the dividends over the price. So we are looking for the price. It will be the price is equal to the dividends over the cost of what? Preference shares. Preference dividends are not tax deductible, so we don't consider tax there. So basically, this is all about the valuation of the business. We value the equity and we also value the debt. That is all. So we just value the two items. We value the equity using the net asset method, or the price earning ratio, or the earnings yield ratio, or the dividend yield ratio, or we use the what? The dividend growth model ratio, which is the Gordon's growth model. We can also use the cash flow method, where they are going to give you a cash flow. You discount all of them and divide it by the number of what? Equity shares that we have. We also value a debt. The valuation of the debt depends on the what? The type of debt it is. It can be irredeemable. If it is irredeemable, we just manipulate the cost of what? Debt for irredeemable what? Debt. If it is redeemable, we just manipulate the what? How we calculate what? The cash flows. How we calculate the cash flows. You see, if we are calculating the cost of what? Redeemable debt, we normally start with the present value. We put it in what? In brackets. Then we add the cash flows, interest, and then the redemption value. We get a negative or positive. Then we move on to the next one. Then we get a negative or a positive. That thing that we are doing to get the cost of debt, which is the internal rate of return, we are just looking for an interest rate that if we use it to discount the cash flows, it will give us this, the value or the present value of the cash flows will be the same as the what? The market value. So that the market value and then the present value will be zero. If you net the two, it will be zero. So we are just looking at the interest rate that can give the present value of all the cash flows to be the same as the market value. So the question will always give you the cost of debt, which if you use it to discount your cash flows, will give you the same value as the market value. So just use that particular rate to discount your cash flows. Then you now have your what? Your market value. So the present value will just be your market value. All right. The talking is, if you are talking without showing working, it will become some way. So let's take at least, right now we are coming to solve questions. So let's take at least 4 questions and see whether the understanding will be clear. So let's take the first question, which is the tutorial question 1. Who is reading the tutorial question 1 for us? Auntie Steph, read the question 1 for us. Auntie Steph, can you hear me? I think you can hear me. If you cannot hear me,
Yeah.
Okay,
Yeah,
Auntie,
I can hear you.
okay. Read the question 1 for us.
The directors of PACCO are considering making an offer to buy 100% of the shares in RightCo, a competitor company. Extracts from the most recent financial statements of RightCo are as follows. Should I read that?
No, forget about those ones and come to additional information.
Okay. Additional information. A recent independent valuation of some of the company's assets showed that the land and buildings were worth 9.6 million Ghana cedis and the plant and machinery 3.2 million Ghana cedis. B, the current assets balance includes a receivable of 0.2 million Ghana cedis from a company in liquidation and some inventory worth 0.4 million Ghana cedis, less than its carrying value. C. Some research into listed companies in the publishing industry shows the following. Average PE ratio 11, average dividend yield 3%. D. Adjustments I above would necessitate a revision of the 2020 draft before tax and draft profit before tax. The dividend payment will, however, not be affected. Required. Determine the value to be placed on each share of Ryco Limited using the following methods of valuation.
Okay.
A.
Okay.
A net assets. B. Price earnings ratio. C. Dividend yield. And D. Please can you scroll up? D. If the return required by the debt holders of right is 7.5%, calculate the market value of the irredeemable debt. Show your answer to the nearest CD.
Okay. That is very simple. So you can see that they have given you a statement of profit or loss. They have given you a statement of profit or loss. Okay. They are giving you a statement of profit or loss. And they have also given you the statement of financial position. And they are saying that the recent independent valuation of some of the company's assets showed that the land and building were worth what? 9.6, and the plants and machinery were what? 3.2. These are revaluation surplus and also revaluation loss issues. So revaluation surplus does not affect what? Our profits. The revaluation surplus does not affect our profits. And revaluation loss over here, we don't know whether there was a previous revaluation relating to this particular asset that resulted in a gain. So we don't know how we are going to adjust it. So the revaluation, either loss or surplus or gain, is not going to affect the profit because they are other comprehensive income items. So we only use the profit for the year. So this particular one, this one, the adjustment in I, it should be maybe adjustment in A and B above would necessitate, may or might. Sometimes they will tell you that, okay, some of the adjustment might reduce or increase the profit. So you have to do those ones before you use the profit. The profit that we use or the earnings per share that we use for the price earning ratio will always be the adjusted earnings per share, or the earnings per share calculated on the adjusted profit. Some of the footnotes will affect the profits, but it wasn't taken into consideration when they were preparing the financial statements. So the recent valuation over here, you can see that the value of the land and building was in the book is 8.5, isn't it? Okay, in the book it was 8.5 because they are keeping 3 zeros, so it will be 8.5 million. Now they are saying that it is 9.6. It has increased by 1.1 million, but this is a revaluation surplus which will go to other comprehensive income, so it is not going to affect our profits. Okay, the plant and machinery is 5.8. Okay, it is now 3.2. It has reduced by 2.6. This is a revaluation loss. We don't know when, or we don't know if there was a previous revaluation relating to this one, which resulted in a gain that we have to write this one against. So we also treat the revaluation loss as other comprehensive income because we don't have enough information to determine whether it will go to profit or loss or it will go to other comprehensive income. So if there's a revaluation, we don't take it to profit or loss, but we only take items that is going to affect our profit. Let's come here. The current asset balance include a receivable of 0.2 from a company in liquidation. So it means that this 0.2 represents what? What will be the name given to the 0.2?
Bad debt.
That will be a bad debt. And a bad debt is going to affect our profit, isn't it? So 0.2 over here. It means that 0.2 was not taken into consideration before determining the profit over here. So the 0.2 was not taken into consideration before determining our profits. Okay, before determining our profits. Let's come to this one. Some inventory worth what? 0.4 less than its carrying value. Some inventory worth 0.4 less than its what? Carrying value. What is the meaning of that? Auntie Steph, what is the meaning of that? Some inventory worth 0.4 million less than its carrying value. Okay, so let's take it like, all right, Auntie Steph, I'm listening.
I'm just guessing. Maybe the current value is higher than the inventory 0.4.
How did you
Like
understand it?
and I said I'm just guessing.
Oh, no, you can't guess and understand it. You can't get understanding. So this is how I understand it. So that we move on.
Okay, I understand it that the current value is higher than the real value of the inventory, 0.4 million.
Okay. Give me figures. Use figures as an example.
Maybe the current value in the books is 20 million, but it's 1 million, but when you go to the market, it's 0.6
Okay.
million. So
Okay. That is a perfect example. Okay. So it's 1 million, but the net realizable value is what? 0.6. Are you okay? The value that they are talking about is the net realizable value. It is the net realizable value. So you can see that the value that they use for the profit or loss statement was 1 million. They have used the carrying value. It is now that they are telling us that the carrying value was what? 0.4 higher than the what? The net realizable value. But the IS2 is saying that inventory should be what? Measured at the lower of cost or its net realizable what? Value. Or they are saying that inventory will be said to impair if the carrying value is higher than the what? The recoverable amount, which is automatically the net realizable value. So it means that we should have carried the inventory at what? 0.6, but we carry it at what? 1 million by subtracting it from what? The closing stock. The closing stock. So it means that we should have subtracted 0.6, but we have subtracted what? 1 what? 1 million. It means that we have subtracted more than we should. So we have reduced our cost of sales. So if we subtract 0.6, it means that the cost of sales would have been higher. So this 0.4 over here is a loss. It's a loss on the inventory. So that will also go to profit or loss as a loss. So you adjust your profit or loss with this one. You adjust your profit or loss with this one. And you also adjust your net asset with this one before you go with the calculation. So let me just take this one.
Linus,
Yes, Inia.
I think I have a contradictory opinion with that one. I think there's some inventory worth 0.4 less than its current value. So,
Okay.
in my opinion, I think it means the current value is rather lower than the original value it is supposed to be worth in the market price by 0.4 million.
Are you sure? Are you
Like,
sure?
that's why I'm saying it's a bit contradictory in my
Okay,
opinion.
okay.
They said
So let me just make it like this. Some inventory worth 0.4 higher than its carrying value. What will be the meaning of that one? Some inventory
worth
0.4 more than its
higher.
more than
So
its
that
carrying
one
value.
means that on the market we in the carrying value. No, let us come again with the question.
Okay, okay. Some inventory worth 0.4 more than its carrying value.
So it means that in the current value is lower than the original value by 0.4 million.
Okay, okay, okay. So right now, some inventories worth 0.4 less than its carrying value. Using the same thing that you have said. It means that the carrying value is more than the what? The value in the market.
Okay.
Okay. So they are saying that you receive 10 cedi less than your brother. So it means that your brother received 10 cedi more than the money that you have received. So you receive 10 cedi less than the amount that your brother has received. So if you look at the amount that the two of you have received, your brother is receiving 10 cedi more than the amount that you have received. That is why you are receiving 10 cedi less than the amount that your brother has received. So it is the carrying value that is higher than the next realizable value. All right. Okay. So let me deal with that question. Then we'll move on to additional two questions and see. So let's look at the question 1. Okay. The first thing is that they are asking us to use a net assets. A net asset method. Okay. Okay, I will solve. Do you know that if care is not taken, we can finish because we still have 1 hour or something. If care is not taken, we can finish the business valuation today. Maybe Friday. But what I normally do is that I will finish it. Then maybe the following meeting, I will just come and solve maybe additional questions. Okay. So that was what I will do. So we solve some 2 questions maybe Friday. Then I will teach the mergers and acquisitions. It's not anything. Within 1 hour, we can finish. Then I will solve the last sitting business valuation question because there are issues concerning mergers and acquisition there so that we just use it to solve all of them at once. So let's look at the net asset method. The net asset method is the total assets minus the total liabilities. So what we do is that we start with the assets. So the assets over here, we normally carry it at their what? Their market values. So let's pick the assets one by one. Let's pick the assets one by one. We have the freehold land and what? Building.
Land and building.
Okay. So let's have the land and the building. So the land and building, the value that we have over there is what? Is 8,500, isn't it? But now they are saying that it's 9,600. So we add the 1,123 to it. So now have the 9,600. So they have given you their new value now, which is 9.6. But it was this one. So you add the increment, you use the 9.6, which is the market value now. So it means that we are going to sell if we want to sell the business, the land will be sold for what? The 9,600. Okay. Let's come to the plants and machinery. The plants and machinery, what is the value in the statement of financial position? It is 5,800, but the market value is now 3.2. So we use the market value. But what are we going to do? We reduce this one by the what? By the decrease. So 5. So we do the 5,800 minus 2,600. Then we now have our 3,200. Okay. Let's now count to the current assets. Let's now count to the current assets. The current assets. So the current assets. What is the value that we have? The current asset is 4,300. Okay. We have 4,300. But this will be reducing by what? You can see that there's a receivables there, which is a bad debt. So the bad debt is still part of the 4,300. So that will be 200. And there's an asset of what? A carrying value, which is 400 higher than the next valuable value. So we subtract 200 and also the 400. So it means that the receivables that they are talking about is still part of the 4,300. So we take the 200 that we are not going to be receiving from it. And the inventory also that they are talking about, the carrying value, which is 400 higher than, is part of the current asset. So we take the 400 also. What are we going to be having?
3,700.
Okay, that will be 3,700. Okay, so what we do is that we are looking for equity. So what we do is that it's just the total asset minus total liabilities. So what we do is you write your liabilities here. So you write liabilities here. So you bring your liabilities. So what are the liabilities? Liability, the first one is the preference shares. Preference shares will be deemed as liability. So we have the preference shares. What is their value? I'm sure it's 8,000. So that will be 8,000. Okay. Then you count to current liabilities. You count to current liabilities. So current liabilities. Current liabilities was 2,200. Okay. So what will be our net assets?
6,300.
6,300.
6,300.
Okay. 6,300. All right. Okay. But what are they asking us? Are they asking us to find the value of a share, or we just find the value of the company? So determine the value to be placed on each share of Rightco Limited using the following methods of what? Valuation. So they are asking us to find the value per share. Okay. So first of all, we have to know the number of shares that we have. Okay. The value of the shares that we have is what? 500. And each share is 50 pesos. So what will be the number of shares that the company is having? So we first have to calculate for the number of shares. Okay. So the number of shares. The value of the shares is what? If you look at the value of the shares here, in the statement of financial position, the share capital is what? The total value is what? 500. And they are saying that each share is 50 pesos. So how many shares, if we issue, how many shares are we going to issue at 50 pesos that will give us 500 Ghana cedis? How many shares? How many shares at 50 pesos that will give us 500,000? How many shares?
1,000.
Okay, that will be 1,000. So we are going to be having the 500 divided by 0.5. That will give us 1,000 shares. Okay, so the value of a share using the net asset method, value of a share will now be computed as 6,300 over 1,000. That will give us 6.3. Am I correct? Okay. I hope I'm correct with that one.
Yes.
Okay. Let's move on to the next one. What is the next method that they are asking us to find? They are asking us to use the price earning ratio. The price earning ratio. So using the price earning ratio, so using the price earning ratio, the market value of a share is calculated as the price earning ratio multiplied by the earnings per share. The earnings per share will be that of the company that we are valuing. So we go and look for the earnings per share of the company that we are valuing. But the price earning ratio will be that of the what? A company in the what? In the industry, a similar company in the same industry, which is listed. Okay. So let's now come here. The earnings per share that we are going to calculate over here will be based on, look at this. So we have to calculate the earnings per share of the company, which is the what? The earnings attributable to the ordinary shareholders, ordinary shares divided by what? The number of shares. Okay. Right. This one, you have to, okay. What is our profit? What is our profit after tax? What is our profit after tax? What is our profit after tax based on what was given to us?
1,540.
Okay. 1,540. But profits, this profit was determined. This profit was determined without taking into consideration the bad debt and also the what? The impairment or the inventory, isn't it?
Yes.
Okay. So what we have to do now is that we have to prepare a draft what? Profit, or we have to prepare a revised what? Profit or loss what? Account, taking into consideration these items. The additional information means that they have not been taken into consideration. That is the meaning of what? Footnote. It means that they have prepared a statement before they have discovered this particular item. That is why they normally make it footnotes. So it means that they have not been taken into consideration. So after you have discovered them, you have to now what? Make the entries for them. So they have determined these ones before they have prepared the statement before they have what? Discover these issues given to us. So what we have to do now is that we have to prepare a revised what? Profit or loss statement by starting with what? Profit before tax. Then we take our bad debt and these ones from it. Okay. So let's prepare the revised what? Profit or loss. So let's do our revised profits. Okay. The revised profits. So the revised profits, we can just start with this. So we start with the profit before tax, which was 2,200. Then we count to the bad debts. Okay, the bad debt is going to reduce. So the bad debt will be 200. Okay, we count to impairment of inventory. Impairment of
400.
inventory will be 400. Okay. So what will now be our profits? What will now be our profit before tax? What will now be our actual profit before tax?
1,600.
Okay, that will be 1,600. I want you to check something. Check something. Find 30% on the profit before tax and see whether it will be 660 over here. Would that be 660?
Yes, it's
Okay.
660.
Okay. I want to tell you something. If you are giving all-in tax, sometimes you can be giving all-in tax and you'll be giving tax. You won't be giving the rates. If you are giving all-in tax, then you adjust your what? Your entries. You do your adjustment to the profit after tax. You assume that the tax will still be the same as what? The tax that was given to you. Okay, if you are giving only tax without a tax rate, it means that the tax that you are going to be paying will be the same as the what? The initial tax. So you only adjust the 600 against this. Okay. But right now they have given you a tax rate. It means that the 30% will be paid on any profit that you are going to make. So if that is the case, then the tax will be reducing over here. So you come and charge your new tax. So your new taxation now will be what? What will be your new tax? That will be the 30.
480.
Okay. So it will be 0.3 times the 1,600. That will be 480. Okay. What will be our new profit for the year now?
1,120.
So 1120. So profit after tax. So this is the profit after tax. Okay. What you have to do is that you first ask yourself, look at the dividends. Look at they have given you a dividend declare over there, isn't it? They have given you a dividend declared. They have given you a dividend what? Declared. They have given you a dividend what? Declared. They have given you a dividend declared. So it means that the profit over here, let's find a dividend on this. Let's find the irredeemable preference share dividend. What will be the dividend for them?
480.
Is it 480? Okay, 480. Okay. How do we calculate earnings per share? It is the earnings attributable to the ordinary shareholders over the number of ordinary shares, isn't it? Okay. Right now we have preference shares here. We are going to pay them dividends, and the dividend that we are going to pay them is what? 480. It means that the figure that we have gotten over here, the 120, the 1020 over here, we have to take dividends, the preference shares dividend out of it before we can use it for what? We can get the earnings attributable to what? To the ordinary shareholders. So if you want to calculate your earnings per share, if you want to calculate your earnings per share, you are going to be having 1120 minus what? 480. Are we okay with that? Divided by what? The number of shares, which is 1000. So we have calculated the number of shares already, which is 1000. So what are we getting?
6.4.
6 points.
Oh,
0 point what?
I'm coming. I think 6.4 or 0.64.
Okay. That will be 0.64. Okay. 0.64. So that is our earnings per share. So we can find our market value using our price earning ratio. What is the price earning ratio given to us? The price earning ratio given to us is 11, isn't it? The price earning ratio given to us is 11. So it will be 11 multiplied by 0.64. What are we having? I'm having 7.
Hello.
Yes, yeah. Zina, can you hear me? I'm having 7.04. Is that correct? Is that 7.04 correct?
Yes.
Okay. But what did we say? We said that we said that this particular company is a company that is not listed. Let's read, let's see whether the company is listed. Let's read whether the company is listed. Okay, let's see whether the company is listed. If the company is listed, it means that we can use the 11 for them. But if they are not listed, then we can't use this one. The directors of Parco. Okay, the 480 is the dividends. The 480 is the dividend from the preference shares. How do we the dividend will be 6% multiplied by the 8,000. That will be 480. So that is the preference shares for that is the dividend for preference shares. We have to take it from the what? The profit before we can calculate our earnings per share. The earnings per share is the earnings attributable to what? To equity shareholders divided by the number of equity shares. That is the earnings per share. So we take the preference dividend first, then we move on. We are taking the preference dividend because this is irredeemable. So irredeemable preference shares will be taken to statement of changes in equity. But if it should be redeemable preference shares, it will be treated as a finance cost. It will be treated as a finance cost in accordance with the what? Financial instrument, IFRS 9. So what we do is that we don't take that dividend from what? From the profit. It means that it has already been treated as a finance cost, which has already been taken from the profit. That will be for business valuation, maybe in that would be business valuation in corporate reporting, but nobody knows. Maybe they can bring the same thing over there. We only take the dividend relating to the preference, irredeemable preference shares from the profits for the year. All right, let me come to this. So I want to know if the company is listed. If the company is not listed, then we can adjust the value that we have gotten. That dividend is for the equity shareholders. Okay. The that dividend is for equity shareholders because you can see the preference dividend is 480. So if the preference dividend is part of this one, it means that it might be more than 250. So since the dividend over here is lower than this one, then this particular dividend is purely relating to what? To the equity shareholders. So they can actually put maybe 730 over here. So if they put a 730 over here, it means that 480 is part of it. Then the remaining one will be for equity shareholders. But since the 250 is lower than the preference shares dividend, it means that preference share dividend is not part of that particular one. So it is purely for the equity shareholders. Okay, that is not what I'm looking for right now. I want to know if the company is listed. If they are not listed, then we just move on. Okay, so since they say some research into listed companies in the publishing industry shows the following. So since they are giving that a listed one, it means that this company indirectly, they are not what? Listed. Indirectly, they are not listed. So since they are not listed, we adjust the market value by 80%. So we reduce it to what? 80%. So what we do is that it will be 7.04 times 0.8. So what are we going to be getting? I'm getting
5.63.
Okay, 5.63. So mostly you have to adjust it maybe by 70% or 80% if you are using the price earning ratio of a listed company. The next one is the dividend yield. We are using the dividend yield. Okay, the dividend yield. The dividend yield will be calculated as the dividend per share over the market value. So we are now looking at the market value. It will be the market value is equal to the dividend per share over the dividend yield. So you have to calculate dividend per share. The dividend per share will be the company that you are valuing, which we can calculate easily. Okay, so you can see that we are giving a dividend over here, which is 250. First of all, before you can know if this particular dividend is purely for the ordinary shares, you have to find the preference dividend and compare with that one. So if you find a preference dividend, you can see that it's 480, which is actually what? Lower than this. But if this particular dividend should be 700, then it means that indirectly 480 is part of it. So you subtract the 480 before, the remaining one will be for the equity shareholders. But since it is lower than the 480, it is pre-assumed that this is entirely for what? The equity shares. So let's find our dividend per share. Our dividend per share is the dividend, the equity dividend. It is the equity dividends over the number of what? Equity shares. So that will give us 250 divided by 1,000. That will give us 0.25. Okay, let's now calculate our market value. So we are going to be having our 0.25 divided by the dividend yield. What is the dividend yield in the question here?
3%.
3%. Okay. Come to this place. A company that is not listed, and a company that is listed, a company that is not listed, and a company that is listed. Which of them that the shareholders are going to be expecting more yield on dividends? A company that is listed and a company that is not listed. Which of them that the shareholders are going to be expecting more yield on dividends?
The listed company.
Is there?
The listed company.
Are you sure? A company that is listed that you can sell your shares at any time, and a company that is not listed, you find it difficult to sell your shares. A company that is listed and a company that is not listed, which of them is having a higher risk?
The one that is not listed.
Okay, so which of them that the shareholders are going to be expecting more return?
It means that the one that is not listed.
Okay. So what we do is that this particular three over here, is for listed company. So it means that a company that is not listed should be expecting a higher yield than this one. So what we do is that we normally increase the yield by 20%. For the market value under the price earning ratio, we reduce by 20%. But for the yield, we increase it because a company that is not listed, the shareholders will be expecting more return than what a company that is listed. So we normally increase this one by what? 20%. Let's increase by 20% and see. Okay. So what will happen is that we now have 1.2, which is the increment of the 20%. So we have 1.2 times 0.03, which is the what? Which is the 3%. I hope you understand the 1.2. We are increasing it by 20%. Or if you like, you can increase and bring the final figure over there. You can find your 20% on the 3%, then you now bring the what? The total value there. So you can increase by 20% and now add the 20% to the 3%. So I'm having 1.2 times 0.03. I'm getting 0.036. So 0.25 divided by 0.036. What are we having? I'm having 6.9.
6.9.
Okay, 6.94. All right. Okay, so the dividend yield is always simple. Why is it simple? Because they will give you the dividends of the equity shareholders, or they will just give you a total dividend. The only workings that you can do is to subtract the preference dividend from the total dividend and get your equity dividend. That is the only thing that you are going to do. That is the only thing that you are going to do. Okay, but for the price earning ratio, you have to adjust your profit with the issues given to you. But if you want to calculate your earnings per share, it is the earnings attributable to the equity shares. So it means that you have to take away the irredeemable preference shares, like the way we did over here. The net asset, use the what? The market value for your valuation. Let's look at the D. What are they saying about the D there? What are they saying about the D? Okay, the D, they are saying that the requirement D, they are saying that if the return required by the debt holders of RightCo is 7.5%, calculate the market value of the irredeemable debt. Show your answer to the nearest what? CD. Find the market value of the irredeemable debt. Find the market value. They didn't ask you to find the what? The value per the debts. They say find the market value. So they are talking about the total market value. Okay. What is the irredeemable debt in the question that they are talking about? What do you think is the irredeemable debt that they are talking about? In the question here, what is the irredeemable debt that they are talking about over here?
The 6% irredeemable preference share.
Okay. So what we do is that they are asking you to find the value of the what? The market value of the preference shares. The 8,000 over here is a book value. So currently, what is the value of the preference shares in the market? This is the value the time that we issue the preference shares, the 8,000, we issued at the 10,000, the 8,000. But currently on the stock exchange market, what is the value now? That is what they are asking for. So they are asking for what? A value, which means total value. So I'm going to show you how you can get this one. But this one, we don't know the number of preference shares that we have. We don't know the number of preference shares that we have. So we use the total approach. We use the total approach. So we have to find we first have to find the cost of preference shares. It is the dividend per share, or the dividends, which can be total dividends, over the total market value multiplied by 100. Okay, so we are looking for the PO. We are going to be having the dividends over the cost of the preference shares. So what is the dividends? That was 480. Am I correct? The dividend was 480, isn't it? It was 6% on the
Yeah.
6,000. Okay. Don't say that they are saying irredeemable debt. So you have a tax rate, so you are going to apply tax on it. Dividend does not attract what? Tax. Dividend is not tax deductible. So we are not going to enjoy any tax benefit on the dividend. So we are not going to apply the 30% on it. But if it should be a debt itself, it means that we will apply or we will find our after tax interest. But this is what? A dividend. So it will be 480. It will be 480 divided by what they are giving to us. What is the cost of the preference shares given to us? They have given something to you over there. The question has given something to you. The question says that if the required is what? 7.5. So that is the cost of the preference shares. So you just divide that by what? 0.075. What are you getting? What are we getting?
6,400.
6.
6,400.
Okay. 6,400. Very simple. Okay. So that is for this particular question. What will happen is that let's pick additional one question so that maybe next week we solve some additional 2 questions. Then maybe we solve like 3 questions together with the mergers and acquisition. But if we can't do the mergers and acquisition, but let's see whether let's try and see whether we can solve additional 2 questions. Let's see whether we can solve additional 2 questions. But this one we are moving from simple to complex. Okay, we are moving from simple to complex. We are moving from simple to complex. So where is the complex? Where is the complex? Oh, this one is very simple. Okay, let's go to simple to complex. What are you? What are you? What are you? Okay, let's look at question 14. This is an ICA question. So sometimes it's very important to solve how they are setting the questions. So maybe okay. So I will solve the question 14. Let's solve question 14. Let me see if I can try some other questions here. So all some of the questions over here will be revision questions. So, okay, let's try the question 14 first. Then I'll see the questions. I don't even know which one I'm going to solve. Let's try the 14. Okay, let's try the 14 first, and maybe next week we solve the maybe 13 and 15. Okay, so let's try the 14. Let's try the 14. Okay, let's see that we can solve additional 2 here. Okay, 14. Auntie Steph, are you there? Auntie Steph, she's not here. Auntie Agnes, can you help us with the reading? Or Senior Prince, can you help us with the reading? Senior Prince, can you help us with the reading? Or Auntie Equia, can you help us with the reading?
Question 14. Campana Limited is in advanced negotiation with shareholders of Zanu Limited to acquire 70% shares in that company. The following financial information is provided for Zanu Limited. Number of ordinary shares, 20 million. Net assets per share, 8 Ghana cedis. Earnings per share, 15 Ghana cedis. Price earnings ratio, PE, 10 cedis. No, 10. The finance director, who performed a due diligence review, recommended the following. 1. Fixed assets included in the net assets were overstated by 6 million Ghana cedis. 2. A key customer who owes 4 million Ghana cedis has gone bankrupt and debt considered irrecoverable. 3. A provision for 10 million Ghana cedis is made for a tax liability. 4. Pampana Limited cost of capital is 10% and risk premium is 4%. And risk premium of 4% is added in the valuation of Zanu Limited to take care of additional operation risk. 5. The finance manager provided a statement showing projected cash inflows for the next 5 years as follows.
Okay, forget about the
Okay,
cash.
should I take the year?
So yeah, just
Okay.
look at the
Required. Okay. Required. Advise shareholders of Pampana Limited on how much to pay for 70% of shares of Zanu.
okay. Okay, using the following methods. Okay,
Okay.
okay.
Of Zanu Limited using the following valuation methods. A. Price earning ratio. B. Balance sheet valuation basis. C. Cash flow valuation. D. Explain 3 reasons. Explain 3 reasons business valuation is undertaken in the corporate environment.
Okay. For that one there, you can answer because we have said that one already. Okay. This is very simple. I'm sure it's even maybe it's August. Maybe it can be August question. Okay, I don't know. Okay. But this one, you see, this one you don't have to answer the question the way it is. You can decide to answer if you can do the balance sheet valuation basis first, fine. You can do that one. If you can do cash flow first, you can do. If you can do price earning ratio first, you can do. Okay. But since we are learning, I will first take this one. Let's take the balance sheet first. Okay. Okay. What is the number of shares that the company is having? What is the number of shares that the company is having?
20 million.
20 million.
Okay. The net asset per share is what? What is the net asset value per share?
8 Ghana cedi.
So what will be the total net asset? What will be the total net assets?
160 million.
Okay, that will be 160 million. Thank you. So it means that the calculation that we have done, our total assets minus our total liabilities was 160 first. But this 160 was gotten without taking into consideration certain issues over here. So if you are starting with the balance sheet valuation method, you have to determine your net asset before these particular issues. So using the balance sheet, you can start with a B, balance sheet valuation. So what will happen is that you start with your net assets. So it means that they have already calculated your total assets minus your what? Your total liabilities for you, which I have done first, that you can calculate it based on book value. Then you now adjust the what? The issues against it. So you can have your net asset, that will be 20 million multiplied by 8, because one share is 8 cedis per the net asset. So if you're having 20 million, it will be 20 multiplied by the 8. So that will give you 8 cedis multiplied. We are going to be having 160 million. Okay, this is the value that we have before we are going to take the adjustment into consideration. Let's take the adjustment one by one. Let's say that fixed assets included in the net asset were overstated by what? 6 million. What is the meaning? And what will be the effect on the net assets? The fixed assets included in the net assets were overstated by 6 million. What is the meaning and what will be the effect on the net assets? What will be the effect on the net assets?
Please, it would reduce the amount of the net asset.
Okay, so it will reduce the value of the net asset, which is 6 million. Okay, let's take the next one. Would that do something to the profits? No, because this is a revaluation issue. So we are going to debit the revaluation and credit the assets. Okay. A key customer who owes 4 million has gone bankrupt and debt considered what? Irrecoverable. Okay. Okay, let's come here. A key customer who owes 4 million has gone bankrupt and debt considered irrecoverable. So the question is, you can see that the current assets, the customer who is a debtor will be included in the current asset, which is also part of the net asset. So it means that there is a 4 million in the net asset, which we are considering that we are going to be receiving it, but they are not telling us that we are not going to receive it. So what will happen? What will happen to the net assets? What will happen to the net assets? We are going to be having a bad debt.
It will decrease.
So we have 4 million. Okay. Let's now come to the next one. So what would the bad debt affect the profits? Would the bad debt affect the profits?
Yes.
Okay. The bad debt is going to affect the profit. So if you are doing the price earning ratio, we adjust the profits. Okay. Let's come to this one. Provision of 10 million is made for what? A tax liability. So it means that first we didn't make any provision for tax liability. When do we make a provision? We are going to make the provision because we are going to be owing the people. So if you are making a provision for tax liability, it means that the provision was not there. It means that we are saying that we are not going to pay tax of that particular element. Now we are saying that we are going to pay a tax of what? 10 million. But this tax liability now, we don't know whether it is a current tax or what? It's a deferred tax. But we assume that it's a current tax. So it means that the time that we are calculating our net assets, the 10 million was not taken into consideration. 10 million was not taken into consideration. The 10 million was not taken into consideration. What is the effect of a liability on the net assets? What is the effect of a liability on the net assets? What is the effect of the liability on the net assets? It's going to reduce, isn't it?
Yes.
Okay. So what will be our net amount now? Would that be 140?
Yes, 140.
Okay. They are saying that you should advise how much they should pay for the 70%. So this amount that we have gotten over here is the full amount. So we just find 70% of this amount. So amount to be paid, amount will be equal to 0.7 times what? 140. What are we getting?
98.
Okay. So they have to pay 98 million. Okay. That is for this one. We are done with this one. Let's now count to the A, which is the price earning ratio. So the price earning ratio, what we do is that our market value is calculated as a price earning ratio multiplied by this one. They are looking at the total value. So we use the profit after tax, not the earnings per share again. We use the profit after tax since they are asking for total. We can also use the earnings per share. But at the end of the day, we are going to multiply by the number of shares. So I'm going to use the 2 to do it so that you understand what we are doing. All right. Okay. What is the earnings per share? What is the earnings per share given to us? What is the earnings per share?
15 Ghana.
Okay.
10.
15 Ghana cedis per share.
Okay. And the number of shares is what?
20 million. So that's 300 million.
Okay. So the total earnings will be what? 300 million, isn't it?
Yes.
Okay. So the profit after tax will be what? Will be 300 million. Okay. So let's now calculate our profit. Let's now calculate our value. Okay. Our value will now be, let's look at this. Our value will now be, our value will now be the 300 million, which is the total earnings, because our earnings per share is calculated as the what? The profit after tax if there is no preference dividend divided by the number of shares. So our earnings per share is 8, and our this one earnings per share is 15, and this is 20. So profit after tax will be at the top. 20 times this one will give us 300. But this one, there will be some adjustment to it. So let's adjust it. Let's adjust it. Okay, the first adjustment will be bad debt, isn't it? The first adjustment will be a bad debt of 4 million. Do we agree? Okay. The first adjustment will be a bad debt of 4 million. Do we agree to that? Okay.
Yes.
Okay. Let's come to the next adjustment. The next adjustment will be what? The provision for the tax liability. The tax is an expense, but before we prepare the statement of profit or loss, we don't have any provision for the tax. So you are going to debit your profit or loss and credit the tax liability. That will be the double entry because that particular thing was not there. So the tax provision over here will also be a tax expense. So it means that we have to take this particular tax element from our earnings because this expense was not there. But if this should have been a deferred tax, still we take the 10 million from what? The profit. So you take the tax, which is an expense of what? 10 million from the profit. Then what will happen is that we multiply this one out by the what? The price earning ratio. What is the price earning ratio given to us? It is 10. Okay, so that will be multiplied by 10. So let's now have the value. The value will be what? This will be, is it 286? 286 times 10. Am I correct? That will give us 2860. Is that correct? Would that be 286? The difference?
Yes, please.
Okay, look at it. Look at this. The following information is provided for Zanu what? Limited. So the price earning ratio is also for what? Zanu Limited, isn't it? The following information is provided for ZANU Limited. So it means that all this information are for ZANU Limited. Since a ZANU Limited is having a price earning ratio, it means that ZANU Limited is listed company. So we don't adjust. We don't, it's a listed company. So we don't adjust the what this particular value. But what will happen is that we want to know the value that they are going to pay for the 70% what shares, because they want to buy 70%. So what will be the value now for the 70%? So I'm having 202 million. Is that correct? Okay. So let's now look at the C, which is the cash flow valuation. One thing that you have to know about the cash flow is that sometimes they consider the company is going to spend some amount of money before they will start receiving the cash flow. So you are going to be using the present value, where the money that person will be spending will be taken as what? As an investment. Then you adjust your present value against it. But that one, there is nothing like that. So we have the years, we have the cash flow, we have the discount factor, and we have the present value. Let's now look at how we are going to determine the discount factor. Okay, let's look at this one. Papana Limited cost of capital is 16%, and a risk premium of 4% is added in the valuation of ZANU Limited to take care of additional operation risks. Okay, we are saying that the cost of capital for Pampana, Pampana Limited, their cost of capital for any investment is 16%. But since they are going to what? Be buying what? ZANU Limited, it means that because of the nature of the operations of ZANU, the operation risks, maybe the component of their fixed cost, which we look at the last time as gearing, operating gearing. Because of the component of their fixed cost and how they are operated, we have to add a risk premium. So it means that if you want to undertake in a project, and a project that is not having a risk, it's 16%. But if you want to undertake in a project that is having operational risk, it means that you have to take a risk premium of 4. So what will now be the total required cost of capital now? What will be the total required cost of capital?
20%.
That will be 20%. So you are going to be using 20% because these cash flows are for what? ZANU. So since you want to use ZANU, it means that the required rate of return, which is 16 for you, you are undertaking ZANU. So ZANU is also presenting additional risks. So they have to pay you for what? The risks over here, which is 4%. So you add a 4% to the 16%. It's just like if you want to invest in government what? Treasury bills, it is 16%. That is no risks. But if you don't want to invest in that one, you want to invest in what? Maybe private bond. A private bond is going to give you a risk of what? 4%. So you tell the people, if you want me to invest in your security, then you have to give me the what? The additional 4% increase, because if I should invest in you, I'm going to be facing the risk of 4%. So give me a premium to cover the what? The 4%. Because if you don't give me the 4%, I will choose to invest in government bond, which is 16% risk free. So since you want me to invest in your security, then you have to reward me for the what? The risk of the what? The 4%. So the person will now be giving you 20%. That will be 4% above the government one. That's the same thing that they are talking about over here. So I'm saying that the question can tell you that Pampana Limited, they are going to be paying 300 cedis for what? 300 million for what? For the acquisition. So what you are going to happen is that you are going to take this as an investment, a cost, like present value. You take this thing as a cost, then you discount all of these things and net it against it to see whether you are going to get a positive NPV or negative NPV. Okay. But this one, we don't have any amount that they are paying. So we only discount the cash flow. So the cash flows are 5 years. Let's discount them fast. So I'm going to have here 1, 2, 3, 4, 5. The first year, what is the cash flow for the first year? The discount factor is 20%. So what is the cash flow for the first year? Can someone write it somewhere so that we just write it?
125 million.
Okay. 125, 60, 150. The last 2 years is what?
200.
Okay,
200 million.
Okay,
And 110.
and 110. What will be the discount factor? The first year, the discount factor will be calculated as 1 over 1 plus R exponent n. So this will be 1 over 1.2 exponent 1, the first one. The second year will be exponent 2. The third year will be exponent 3. I have 0.833, 3 decimal places for the first year. Is that correct?
Yes.
Second year
Yes.
will be what?
0.694.
0.694.
Oh.
Okay. Third year will be what?
0.579.
0.579.
9.
Okay. The fourth year,
0.482.
0.482. The last year,
No, the fourth
0.
year is yeah.
You're right. 0.402. 6 years.
0.402. So let's find the present value now.
0.402.
Okay, let's find the present value one by one for them. The last year, 110 multiplied by 0.402.
44.22.
Okay, 44.22. Okay,
Year 1, 104.13.
okay, 104.13. Okay,
Year 2, 60,
What's one?
41.6.
so someone is watching Ghana match and still listening to class. Hey, people are serious. Oh. We have people in this country who are still watching Ghana match. People, you have heart. Zero 0.579 times
So
1.
what is the score?
86.
Year
Score
3.
Ghana also.
Year 3.
Okay.
Year 4,
Okay.
year 4, 96.4.
96.4. Okay. So someone was able to add all of them.
$373.24.
Okay.
373.24.
373.24. Okay. I'm saying that maybe they can tell you that the company will pay 300 cities for this particular investment. So what will happen is that you will now take your, because this is the cash flows that you'll be receiving, but you have already paid 300. So what will be the net cash flow? Then you now have
Sorry,
76.24.
number 3, year 3.
Yeah.
0.579.
Yeah, 0.579.
Okay.
Okay. So I'm saying that they can say the company is going to be paying 300 cities for what? The company is going to be paying 300 cities for the investment, or they are going to buy them at 300 cities. So they can ask you to advise whether they should purchase or not. What you are going to do is that you discount the cash flows and compare with the amount that you are paying and see whether there will be a positive NPV. If there's a positive NPV, then you can say that they should purchase them. Okay. But this one, there is nothing like that. So what will happen is that we are just having the 3,734. So what we do is we multiply it by 70% to see how much they are paying, because this is 100%. So we multiply by the value, which will be 0.7 multiplied by 373.24. What are we having? I'm having
This is 1.27.
261.27 million. So this is the amount that if they are using cash flow method, this is the amount that they are going to pay. If they are using the price earning ratio, this is the amount that they are going to pay. If they are using the asset valuation model, this is the amount that they are going to pay. Okay. So you can advise them the amount that they are going to pay, but the people who are going to sell the business are the people who are going to give you the price. So you will just have to negotiate on the price that you are going to pay. Okay, so the people will tell you that you should pay them based on the price earning ratio, because that is giving you the highest one. That is giving you the highest one. Or you can also say that you can only pay them the 373, because you are going to base your negotiation on the cash flows that a company is going to be generating to you. So you can also use the 373. So this is the value that you are going to be paying for them. 261.27 rather, not the 373, because you are buying only 70%. Let's look at the other part, the B part of the question. That one we have even spoken about that one already, where they are saying that explain 3 reasons business valuation is undertaken in the corporate environment. I hope we have talking about that one already. We have spoken about that one already. Yeah, I hope from the beginning we have talked about this one already, isn't it?
Yes, sir.
What are
Yes.
some of the reasons?
When it is an unquoted company and it's about to list on the stock exchange.
Okay, if the company want to go public for the first time, okay. When there's a takeover, when the shares are going to be sold, when when some of the shareholders want to sell
When the
them.
company wanted to,
Okay. Someone is saying something. One of them is in the question over here. You can see that some people want to sell 70%. So when the shareholders
I
are
said when the company want to list his shares at the stock market.
okay, someone has said that already. The company want to go public for the first time. When there's a takeover, we can also do valuation as a form of collateral security to take loan. We can also do the valuation when a parent want to dispose its shareholding in the subsidiary, or when some of the shareholders want to dispose what their shareholding, which is the 70% that we have over here. All right. Let me take additional one.
Mergers and acquisitions.
Okay, when there is a mergers and acquisition. So for the business valuation, they normally mix it up. You are going to see a question on a calculation, and also you are going to see a question on you are going to see a question on the okay, question 15. We will look at that one later, but not today. Okay, so let me take question 15. We'll be taking on Friday with some other questions. Let's take the question 16, which is valuation of what? Valuation of debt. Okay, let's look at this valuation of debt within 5 minutes. Then we know that we have looked at the valuation of the 2 debts. We look at the redeemable, then we are going to look at redeemable. Okay, whatever the question that they are going to ask, all of them will be sentenced on the valuation of equity. They all be about valuation of equity. Okay, let's take the 16.
Question 16.
Okay.
Food Limited 12% bond with a par value of $150,000 and redemption value of $165,000 with interest payable quarterly. The cost of debt on the bonds are 8% annually and 2% and it is now 31st December 2017. Required. Calculate the market value of the
Okay. So the bonds are what? Redeemable. Okay. It will be redeemed on what? 30th June? 30th June 2021. And they are saying that it is now 31st December 2017, which is the same as 1st January 2018, isn't it? Is it the same as 1st January 2018? Okay.
Yes.
Okay. So from 1st January 2018 to 30th June 2021, how many months is that? How many months is that? Would it be 6 years? How many years is that?
3.5.
Okay, 2018 will be 1 year, 2019 will be additional 1 year, 2020 will be additional 1 year. The 2021 will be only 6 months, so that will be 3.5 years.
3 years, 6 months.
Okay, so that will be 3.5 years. Okay. All right. The question now is they're asking us for the value. Okay. They're asking us for the calculate the market value of the bond. So they are talking about the total market value. The total market value. Or you can also find the unit market value. There is no problem with that. But since they are giving the redemption value, they have given a redemption value at 165. They are giving you a redemption value at 165. So the advice that I'll give to you is what? Just use the what? The full value. Sometimes you can also use the 100 because we know that all bonds are issued in a unit and each unit is what? 100 Ghana cedis. So we find the interest on the 100 Ghana cedis and try to find the market value per unit. But this one, they have given you a total value. So also find the market value in total. Okay. But for me, I can find in total, I can find in units. If I want to find in units, first of all, I have to ask myself, each unit is what? 100 cedis. So how many units will be issued so that I will get 150? That will be 150,000 divided by 100. I will be issuing 1,005 units at 100. And that will give me this one. So if 1,005 units, I can divide this also by 1,005 units to get my unit value. Then I can use it to find my value of the what? The bonds. But I'll use total value because the question has given us total value. Okay. You can also calculate the market value on yearly basis, or you can also calculate it on what? Quarterly basis. The question is saying that the interest is payable quarterly. So it means that you have to use quarterly rate to find your what? Market value. We say that the market value of this one is just the present value of all the cash flows. It's just the present value of all the cash flows. That is all. Discounted at the what? The cost of the debt rates. Okay. So the interest is payable quarterly. So let's set up our listing. So let's look at the question 16. We are going to have the years. It will not be years, but it will be quarter. So let me put the quarters here. Okay. Because we are doing quarters. So I'll do quarters and years. But actually you have to do it in quarter basis. You have to do on quarter basis. Okay. Then we have our cash flow. We have our discount factor. Then we have our present value. Okay. Let's now come to the question. Let's do quarterly and yearly. So I'll do the yearly here and see the figures that you are going to be getting will be as a result of what? Approximation. The difference will be as a result of approximation. So I'll use the 2 all. Okay. I'll use the 2 all. What is the interest rate of the what? Of the bond? It's 12%, isn't it? Okay, it is 12%. So the interest rate is 12% on the nominal value. So the interest will be how much? 12% on the nominal value. That will be a year. But we are doing it quarterly. So we divide by 4. Or you can find quarterly rate over here, which will give you 3%. Because we have 4 quarters in a year. So 12 divided by 4 will give us 3%. You multiply 3% by this, and you give us the quarterly interest. Okay. So let's get the quarterly interest now. 0.12 times 150,000 divided by 4. I'm getting 4,500. Is that correct? Okay. We are doing quarters, and this particular bond will last for 3.5 years. The question now is, how many quarters can we see in 3.5 years? We know that a year is what? 4 quarters. Additional 1 year is 4. So 3 years will be 12. But the 6 months will give us 2 quarters. So it will be 14 quarters in the 3.5 years. So a year is 4 quarters. Additional 1 year is 4. So the 3 years is going to give us 12 quarters. The 6 months on it will give us what? The 14 quarters. It means that the company is going to pay the interest for what? 14 quarters. So 4,400 every quarter. And you are going to, this particular bond will be with the organization for 3.5 years. It means that you are going to pay the interest for 14 times. So we do annuity. Annuity will be 1 to 14, which will be 4,500. What we do is that a discount factor will be the cost of the debt. So the discount factor over here will be the cost of the debt, which is the 8%. But on quarterly basis, it will be 2%. So we use the 2% over here as a discount factor. So we are going to use 2% over here as a discount factor. So we find annuity for 14 years. Because we are using quarterly, we assume that this is what? 14 years or 14 quarters. But at the end of the 14th quarter, they will now redeem the what? The bond by paying 165,000. So at the end of the 14th quarter, at the end of the 3.5 years, they will now redeem this one by paying what? 165,000. So let's calculate the interest rate. Let's come to this particular one. Let's use the yearly one. This will be 1:3.5 years. Okay, because they are going to be paying the interest, or the amount, the loan will be with the company for 3.5 years. So that will be 1:3.5 years. They are going to pay this one for 3.5 years consecutively. And this one, the interest will be yearly, which will be 18,000. And this will be 8%. You'll be getting the same answer, but the approximation will be different. So this will be 3.5. At the end of the 3.5 years, you will now pay the 165,000. So let's find the 2 and see. Let's find the 2. So let's find the annuity factor. That will be 1 minus into bracket 1.02 exponent negative 40 divided by 0.02. What are we getting? What are we getting for the annuity factor? 1 to 14. Nobody's having calculator.
I'm coming.
12.106.
It's what? 4 points of
What I have here is
12.106.
12.106. Is it 12?
I'm having some negative here.
No, you do the exponent first before
Yes.
the subtraction. So the 1.02 exponent negative 14 first before you subtract the answer from 1. Then did you get it?
I'm doing it.
So the 1.02 exponent negative 14 first. Then you subtract the answer from 1. then all of the answer divided by 0.02. So don't do 1 minus 0.1 minus 1.02 before you do the exponent, negative 14 of the answer. No. The negative 14 is affecting only the brackets. Okay. Let's
I
count.
had 15.97.
You are getting what?
15.97. I don't know if I'm right.
15.97. Someone is saying 12.106. Which one is correct?
Yeah, I also get 12.106.
Okay, 12.106. So the 15% should try again. Let's count to the
Okay.
discount factor for the 14. The 14, that will be into 1 over 1.02 exponent 14. This one is a one-time payment, so we use the what? The discount factor. But if it is a payment that is going to be equal, we use the annuity. But it's a one-time payment, we use the discount factor. So that will be 1 over 1.02 exponent 14. What are we getting?
0.758.
0.758. Okay. Let's come to the yearly one. Let's find the annuity. The annuity will now be 1 minus into bracket 1.08 exponent negative 3.5, all divided by 0.08, because we are using 8% as a discount factor. Yeah, Auntie Lizzie. Auntie Lizzie, your hand is up, or it's a mistake? Auntie Lizzie, your hand is up, or it's a mistake? Okay. All right, let's look at the annuity factor for the 8% for 3.5 years. What are we getting?
2.952.
2.952.
952.
2.952. Okay, someone should confirm that. Okay. Is it confirmed?
Yes.
Okay. Let's count to the,
Confirm.
let's count to the discount factor. 1 over 1.08 exponent 3.5, because the 165 will be a one-time payment. What are we going to be getting?
0.764.
0.764.
0.764.
Okay. So let's now find the present value now. Let's multiply them. So 4,500 multiplied by 12.106. What are we getting? I'm getting 54477.
477.
Is that correct?
Yes, sir.
Okay. Let's look at 165,000 multiplied by 0.758. I'm getting,
125070.
125070.
okay. Let's put the two together.
179547.
179547. So this is the market value. But let's count to the yearly one. You'll be getting the same thing, but just that there will be a difference in the as a result of the approximation. So 18 multiplied by 2.952. I'm getting
53136.
53136. Okay. Let's count to
The second one is 126060.
126
060.
060. So if you add, you'll be getting something.
179196.
Okay. 179
196.
196. So you can see that you are still getting something like 179, but it's just that the last 3 digits is the difference because of the approximation. Okay. So, but you have to use the quarterly, since the question is saying that the interest will be paid quarterly. That is all. So for the value, for the market value of the irredeemable debt, you just what? Discount, you just present value or the cash flow using the cost of the debt. The answer will give you the market value of that particular redeemable debt. So that is all about the redeemable debt. So let me see the questions that we can. Let me just save this working sheet and share with you, and see the questions that we can solve maybe next. Let me see. So Friday we after we finish with the mergers and acquisition, you pick at least question 15. You pick the question 15 and with some other questions, or question 13, or I can pick the question 15, then I'll solve last sitting question. Then maybe the rest of the questions there, at least we are going to solve maybe at least 5 of them during revision. Okay, but I'll give them to you as an assignment. Okay, give the revision ones to you as an assignment. Okay. So seniors, this is all about the business valuation. This is all about the business valuation. This is the business valuation part. How to value equity, the methods that we use to value equity, and then how to value debt. That is all. That is all. These are the methods that we use. So, all right. So any question? Any question? Any question? I will try and see. Like at least we have solved at least maybe 4 questions. Yeah. Is it 4? Okay, we have solved at least 4. Let's solve additional 3 so that maybe 7 before we solve different questions during revision. Yeah. So seniors, that is all for business valuation 1. I'll make it the 1 so that Friday we will solve additional questions before we move on to the mergers and acquisition. Even if we are not able to finish the mergers and acquisition, we do the mergers and acquisition on Sunday. But next week we are going to start working capital management. So after that one, after mergers and acquisition, then it means that we have 3 topics left. Working capital management, which we can use 2 meetings to finish. Then we look at investment appraisal techniques. That can take like maybe 4 meetings. Then we look at financial risk management. Then I can now leave you to do your own studies. After your studies, then I'll call you from retirement that you should come back to do revision for 5 days. That's all. So seniors, that is it. Try the time value of yeah.
What about treasury management?
But the treasury management is part of the working capital management. Okay. And it's also
Capital there.
capital.
I'm looking at the ICM manual.
Yeah. We have the soft and then the hard. Is that what you're talking about? Yeah, they are under that one is under investment appraiser. Where we have independent projects and mutually exclusive projects. We also have profitability index and those ones. They are under investment appraiser. But the treasury management is under, part of it is under working capital management, where the people have to manage cash. Part of it is under financial risk management. Yeah, so we look at all of them. So don't worry. All right.
Okay.
Okay.
Thank you very much.
Okay, senior.